For business assets, the first question is simple. Do you deduct it now or capitalize it into basis and depreciate it over time? The tangible property regulations are the playbook for that decision. They apply to basically every business that buys, fixes, maintains, improves, or disposes of physical property. On the EA exam, they love scenarios that feel like just a repair, but actually trigger capitalization. Under the regs, an improvement is anything that meets one of three tests: betterment, restoration, or adaptation to a new or different use. Think of these as three separate doors into capitalization. If you walk through any one door, the cost is an improvement. Basis goes up, and you recover it through depreciation, not a current expense. Betterment is about making the property materially better than it was. The exam angle. Don't get distracted by the taxpayer's label like maintenance. Ask what changed. Did it fix a material condition or defect? Did it add a material increase in capacity, productivity, efficiency, strength, or quality? If yes, you're likely in betterment territory and you capitalize. Restoration is the one they test with dramatic facts. If the unit of property has deteriorated so badly, it's no longer functional for its intended use. Bringing it back is a restoration. That's capitalization. Example, a farm outbuilding fell into disrepair and couldn't be used. Shoring the walls and replacing the entire leaky roof to make it usable again is a restoration, so the full cost increases basis and is depreciated. Adaptation means you change the property to a new or different use. The key is different use, not nicer. If a space or asset is converted so it serves a different business purpose than it did before, that's adaptation and it's capitalized. On the EA exam, watch for conversions, like changing a storage area into a retail showroom or reconfiguring a building for a new line of business. Now zoom out. The regs also include safe harbors that can allow expensing even when you're dealing with tangible property costs. You don't need every detail memorized here, but you do need to recognize the names and what they're trying to do. Simplify and allow current deductions in specific situations. If a question hints at elections or safe harbor, your antenna should go up. Quick exam workflow. Identify the unit of property, then run the 3 improvement tests: betterment, restoration, adaptation. If none apply, you're usually in repair or maintenance, so deduct. If any apply, capitalize and depreciate. And if the facts mention a safe harbor, check whether it allows expensing anyway. That sequence keeps you from getting trapped by wording like repair or rehab. Marisol is a self-employed midwife with a home office. Her principal place of business is her home, but she rarely meets clients there. She travels to clients' homes to perform her work. Which statement is correct? She can't deduct round-trip transportation from home to clients. She doesn't have a qualified home office. She can deduct round-trip transportation from her home office to clients, or none of the above? Think about it. The correct answer is that she can deduct the round-trip transportation between her home office and her clients' homes. If the home office qualifies as her principal place of business, trips from that office to client locations are business transportation between work locations, not non-deductible commuting. The tempting wrong choice is the one that treats home to work as commuting, but a qualified home office changes that result. Harborview Realty buys a commercial building with a $200,000 down payment and assumes a $120,000 mortgage. They also pay $4,000 in attorney's fees to perfect title and $20,000 of permanent improvements before placing it in service. The property tax bill values the land at $70,000. What is the basis for depreciation? $274,000, $250,000, $324,000, or $320,000? Think about it. The depreciable basis is $274,000. Start with total cost basis. The down payment plus assumed mortgage, plus title legal fees, plus permanent improvements. That's $200,000 plus $120,000 plus $4,000 plus $20,000, or $344,000. Then remove land, because land isn't depreciable. Subtract the $70,000 land value, leaving $274,000. A tempting wrong answer is $344,000, forgetting to carve out land.